Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Welcome! If you're running a Canadian business and you're looking to sell your products or services abroad, you are on the verge of a massive opportunity. But before you start shipping goods and signing international deals, we need to talk about something that is absolutely critical to your success: taxes. Getting this right isn't just about paperwork. It's the key to making sure your global expansion is actually profitable. Going global can be a complete game changer for your company. But it also opens up a whole new world of pretty complex tax rules. And honestly, a simple misunderstanding of how to handle these can turn a really profitable new venture into a very costly headache. So let's spend the next few minutes making sure that doesn't happen to you. So here's our game plan. We'll start with a big picture, the main tax challenge you face when you cross borders. Then we'll zoom in on tricky details, like dealing with foreign currency and the crucial difference between income and capital. From there, we'll get into the nitty-gritty of the direct export model and unpack a key concept called permanent establishment. And we'll wrap it all up with a practical checklist to keep you on track. All right, let's get right into it. The very first thing you need to wrap your head around when you start operating internationally is this idea of dual jurisdiction. It might sound like complex legal jargon, but the concept is actually pretty straightforward. Basically, you're now playing in two different sandboxes, and each one has its own set of rules. Your business activities can now be taxed by the country you're exporting to, and they're still taxed here at home in Canada. To figure out your true profit, you need to know exactly how much tax you'll pay in each place, and just as importantly, when you have to pay it. Now, let's talk about something every single international business has to deal with: foreign currency. You sell in US dollars, euros, or yen, but you report your income in Canadian dollars. The value of that money is always changing, and those fluctuations create real gains or losses that the CRA definitely wants to know about. Think about it. From the moment you issue an invoice to the day you actually get paid, the exchange rate can shift. That creates a gain or a loss on paper. For tax purposes, we have to get very specific. Is that gain considered business income, or is it a capital gain? And when do you have to report it? The answers to these two questions are absolutely fundamental. And here's where it gets interesting. You might look in the Canadian Income Tax Act for a clear rule on this, but you won't find one. The Act is silent on how to classify these gains. So, to figure out the correct tax treatment, we have to look back at the original transaction that created the foreign currency exposure in the first place. So here's the key distinction you have to make. If the currency gain or loss comes from your regular day-to-day business, like sales to customers, collecting receivables, or buying inventory, it's treated as business income. But if it's related to a big-ticket capital item, like selling a piece of machinery or a building abroad, it's treated as a capital gain, and that makes a huge difference in how it's taxed. This also highlights the critical difference in timing. For your business income, you use the accrual method. For example, say you have an outstanding invoice for $10,000 at your fiscal year end. You have to adjust its value on your books to the current Canadian dollar equivalent and report any foreign exchange gain or loss right then, even if the client hasn't paid you yet. But for capital assets, it's a completely different story. You don't use the accrual method here. The foreign exchange gain or loss is only calculated and recognized when the deal is truly done, when the asset is actually sold and you've received all the money, or when a long-term loan is fully repaid. The timing is tied to the settlement, not the balance sheet date. Okay, so now that we've got a handle on the currency side of things, let's see how it all fits into the direct export model. This is usually the first, most straightforward way for businesses to start testing the international waters. The view from here in Canada is pretty simple. Canadian corporations are taxed on their worldwide income. That means revenue from a sale to a customer in Germany or Japan is included in your business income and taxed in Canada, just like a sale to a customer right down the street. But here's the critical part. The other country has its own rules, and most of them will only tax you if you are considered to be carrying on business inside their borders. So the multi-million-dollar question becomes, what does carrying on business actually mean? And that's where this concept of a permanent establishment, or PE for short, comes into play. This is probably the most important term for any direct exporter to understand, because it's what international tax treaties use to define that carrying on business threshold. Tax treaties, like the one between Canada and the US, define a permanent establishment as a fixed place of business.
Basically, a physical presence in the other country where you conduct your operations. And here is the key takeaway. If you do not have a PE in that country, your business profits are generally not subject to their income tax. So what counts as a PE? Well, the definition gives clear examples: a dedicated place of management, a branch, a sales office, a factory, or a workshop. If you have a physical fixed base of operations like any of these in the foreign country, you almost certainly have a permanent establishment and will be subject to their tax laws. But here's where it gets nuanced. Tax treaties also list specific exemptions. For example, simply using a warehouse to store, display, or deliver your products does not automatically create a permanent establishment. The key is that these activities are considered preparatory or auxiliary, not the core of your business. Now, a crucial word of caution here, especially for service-based businesses. Even without a fixed office, you can be deemed to have a permanent establishment if your people spend a significant amount of time providing services in the foreign country. This is a very common trap. This is the number you need to burn into your memory. The 183-day rule is a standard feature in most tax treaties. If your people are physically present in a country providing services for 183 days or more within any 12-month period, it can trigger a deemed permanent establishment, subjecting your service revenue to foreign tax. So how does this rule work in practice? It's typically triggered in two ways. First, if your company's work on a single project or related projects adds up to 183 days. Or second, if you have one key individual who spends that much time in the country and their work there is so valuable it generates more than half of your company's entire business revenue, you have to track those days very carefully. So as you can see, understanding these definitions is absolutely crucial. It allows you to strategically structure your export activities to, hopefully, remain below the threshold of being taxed in that foreign market. With that in mind, let's go over a quick checklist of things to consider before you expand. Before you make your move, ask yourself these questions. Do we have a clear process for classifying our foreign currency transactions as income or capital? Do we know exactly when to report those gains and losses? Are we being careful to structure our physical presence to avoid creating a PE? Are we meticulously tracking the days our team spends abroad? And most importantly, have we actually read the specific tax treaty for our target country? Because the rules can and do differ everywhere you go. And this is the essential question to end on. A well-planned, proactive tax strategy isn't just an administrative afterthought. It's a foundational cornerstone of successful and profitable international expansion. Making sure your tax strategy is as robust as your sales and marketing plan is absolutely critical.